So 2 weeks ago, I did a video on Visa, and in that video, we took an in-depth look at their valuation in light of this recent sell-off that has occurred across payment companies. So you can see this on screen now. PayPal, Visa, and MasterCard have all fallen a lot in recent months, but PayPal specifically has fallen much more significantly. So to continue this theme, I thought I'd do the same type of video with PayPal. This company's gotten a lot of noise recently, as many people are pointing out that now may be a good time to open a position in a business that does appear to be quite strong, despite the factors that have caused this recent sell-off. So what we'll do in this video is we'll go over the PayPal business. We'll look at some trends happening in the payments industry, similar to what we did with Visa, and then we'll value PayPal using the discounted cash flow model to determine if they are actually a good buy at present time, and play around with our assumptions in that DCF model to determine what sort of future performance is currently being priced into PayPal stock right now. So without further ado, let's get right down to it. Now, the payments industry as a whole is one that's complicated to analyze because there's just so many trends taking place right now that could really alter the future landscape of this industry, with everything that's going on from fintech to decentralized finance, the rise of buy now, pay later options. It's kind of difficult to predict how people will be making payments 10 years into the future. Now, PayPal has long been a leader in this market. They originally started from the idea that consumers don't want to put their credit card info into so many different websites when they're shopping online. So it'd be better if they could just put their personal data into one payments platform and then just pay on various sites using that. And the business has become very successful over the years, and it's built up quite an economic moat. And this moat stems from the platform aspect of the business. It's having more users on that platform, which leads to more merchants wanting to accept payment via PayPal. And then because there's more merchants that accept it, there's more users that join the platform. And thus you have this network effect. And this is really the secret sauce for any sort of payment processing business. And I think we're seeing evidence of this in PayPal through the chart that we can see on screen right now. Their user accounts continue to grow at high rates for over a decade now, and they currently sit at over 350 million active users. And they actually account for about 22% of all online transactions that happen in the US at present time. So very significant, and it does show that the PayPal business is quite strong and it is still growing. So moving on to industry trends now, the three significant tailwinds that PayPal faces are: number one, growth in e-commerce and online shopping. And I don't think I need to go too in depth on this one because all the research out there that you can find points to this being a double-digit growth sector for at least the next 5 years and probably even long into the future. And PayPal is a company that obviously it processes online payments, so it will certainly benefit from growth in that whole industry. And number two would be growth in digital wallets. PayPal has a very strong cryptocurrency presence. So if you believe in the underlying technology of crypto and not necessarily individual cryptos like Bitcoin and such, then PayPal is a great company for exposure to that trend. And a third key trend in this industry would be the rise of buy now, pay later options that allow you to make installment payments on your purchases rather than paying for the whole amount upfront. And this sector has seen massive growth in recent years, and PayPal's buy now, pay later option service has already amassed over 7 million users. And they're even going to stop charging late fees to their consumers, which I'm sure will lead to more growth in that service. And as we can see from the data here, the adoption in really only the last 2 years has increased rather significantly, as we can see across all different cohorts: Gen Z, millennials, Gen X, and baby boomers. They're all using this service more often. And if we scroll down to actually look at buy now, pay later retail purchases in the US specifically, we can see clearly that there is expected to be very significant growth going into 2021 and probably more in future years as this service gains more popularity. And now in terms of headwinds, so threats to the PayPal business, it's mainly the loss of key merchants. eBay obviously was a big one, and news came out about eBay no longer accepting PayPal on their marketplace a few months ago, which is one of the reasons for the massive sell-off that we saw in PayPal stock. But it's not like eBay was a high growth aspect of the PayPal business to begin with. Yes, they were their largest customer, but as we can see here, they did have consistent growth in their total payment volume, even if you exclude eBay. So we're looking at Q3 year over year, and they had 31% growth even when eBay is excluded from that. So that shows that, yes, eBay or losing eBay is not ideal for PayPal, but it's not something that's going to be detrimental to the business. And if we actually look at eBay's revenue over the past few years, we can see it's been rather stagnant. It's not like eBay is this hyper growth company that was going to be key to increasing PayPal's revenue in the future years. Really, the only reason PayPal probably had a bump here in 2020 and then into 2021 was just because of the increase in online shopping that happened because everyone was locked down and couldn't go into stores to buy stuff. In the years before that, we can see their revenue growth was actually pretty stagnant. So personally, I wouldn't be too concerned about this loss. Yes, it is something that will materially change the business, but is it something that is going to really lead to the downfall of PayPal? Definitely not. And further to this, PayPal recently struck a deal with Amazon where Venmo customers are going to be able to pay using Venmo when they check out at Amazon. And this is specifically in the US, and it will take effect at the beginning of 2022. And it's probably going to be a while before we actually start to see the effects of this deal take place in the financial statements of PayPal, because these types of changes kind of take a while for consumers to get used to and start actually using the service. But I do have confidence in this deal, and I would say that you can expect it to account for a lot of the losses that losing the eBay marketplace would lead to in PayPal stock. Another notable headwind that's taking place relating to PayPal is the rise of competition, specifically other networks out there who are growing very fast in their own right and gaining a lot of traction. And specifically, you can look to Square's Cash App. This is a service that in the US has been growing very rapidly and is quickly turning into a real cash cow for Square as a business. And I talked before about how when it comes to payment processing companies, you're really looking for network effects because more customers means more merchants, or even if you have an app that can be used for peer-to-peer transactions, if there's one app that consumer tastes really prefer, and a lot of people start to use that, then people will shift away from their existing solutions, which could be PayPal, to the one that everyone else is using. And if it just happens to be a better service, which may be evidenced by how fast Cash App is growing, then that could definitely take away some payment volume and some traction from PayPal and move it into Square. They are a very strong competitor in this market, and they definitely need to be considered. And although Cash App isn't the exact same thing as PayPal, any transaction network that is growing this fast and taking payment volume away from existing services and potentially disrupting the industry definitely needs to be considered as a true competitor. Okay, so moving on to the discounted cash flow valuation of PayPal now. So here is the DCF model that I've used, and I first want to start by looking at the cost of capital. So for the cost of equity part, I use the capital asset pricing model. So this assumes a 2% risk-free rate, 6% market risk premium, and then an unlevered beta of 1.2. So this gives us a cost of equity of about 9.2%. And then the cost of debt is about 2.6%. And this is a very low cost of debt. They have a very low interest rate, likely due to the fact that they probably have a very high credit rating just because they have a ton of cash on hand already, and the business itself generates a ton of cash. So they're able to negotiate a very low interest rate on their debt. And they really didn't have a whole lot of debt until a few years ago, which it made sense for them to take on debt just because it's such a cheap form of financing. And their return on invested capital is already much higher than the cost of debt anyways, as we can see down here, 5-year average of 12.5%. And then in the last 12 months, 17.7%. So, and I'd assume that's going to increase in the future as the business continues to grow. So they're primarily financed through equity, 96%, with a little debt, just about 4% there. And then their effective tax rate is about 15.5%. And it's lower than what you'll typically see with Canadian and US companies, just because they do have some foreign income, which I believe is taxed at a different rate. So that's kind of why it's a bit lower there. But their cost of capital overall, just under 9%, 8.9% there. Now, running through the actual assumptions here, I assumed 18% revenue growth from 2022 to 2025. Now, if we take a look at what it has been historically, so right here, you can see their revenue growth has pretty much been growing about 18%. And it's fluctuated a bit, but it's usually around that 18% mark. And management recently said in their guidance that they released that they expect 18% revenue growth for 2021. So I just assumed we'll get 18% going forward. Now, again, The whole point of these DCF models that I do is not to pull out my crystal ball and project the future. What I'm trying to do is show you guys what's currently being priced in to PayPal stock, what sort of assumptions lead to it being fairly valued, maybe slightly undervalued or overvalued, and then you can make decisions for yourself based on whether or not you actually believe that these future performance metrics will materialize. So 18% revenue growth into 2025. And then I'm assuming it will taper off. So 12.5% revenue growth, 12.5% revenue growth into 2031. And then the operating margin or the EBIT margin, which is another key input, in the most recent years, about 17.5%. And I'm assuming it is going to grow at 0.2% a year. Now, this may seem a little counterintuitive because we look at what the operating margin has been historically. You could say it's grown from 16.2% in 2013 to now about 17.5%, but it has been fluctuating a lot. But I do think that as PayPal grows its revenue, it will achieve economies of scale as they can cover their fixed costs more effectively. And as their revenue also grows, they're probably going to put more effort on reducing their costs, especially in these later years of the model once the revenue growth starts to taper off and they need to continue to show to investors that they can increase their profitability as an enterprise. They're probably going to focus more efforts on cost cutting. You know, this is typical what you see businesses do as they mature a little bit. And then I used a similar tax rate here to deduct the taxes paid. Capital expenditures, I just assume they will continue to grow at the same rate they've been growing historically. Same thing with depreciation, amortization, and then working capital. You know, these figures down here aren't super important to the model overall, but I just kind of looked at what they had been historically and then assume they will continue a similar trend and grow slightly as the business overall grows. And this model, by the way, is assuming the year ends September 30th. So since we're assuming we're buying the stock today, which would be January 1st or January 2nd of 2022, then you get 75% of the first year cash flow. So moving on down here, we can see we get an enterprise value of 210 billion. Now, the way I calculated their terminal value, which we can see is a significant part of the company's total value, is I just took a multiple of the final year cash flow. So we go back up here to assumptions. I assumed a 30 multiple. Now, I'll show you why I used 30. So if we go to the valuation tab here on Ticker Terminal, which is the software I use, and if we look at the enterprise value to unlevered free cash flow multiple, we can see it's been, here's the 60x range, and here's the 40x range. It's dropped to 40x sometimes, but it's kind of hovered in between 60x and 40x. So I'm assuming it's going to go down to 30x, which I think is a reasonable assumption just because these multiples tend to contract as businesses grow and they kind of realize some of their higher growth rates. And I think it does make sense to assume that PayPal is going to grow faster in the next 5 years than they would if you're going out 10 years, 15 years into the future. And then I assumed cash investments of 30 billion. So this is obviously going to grow as the company generates cash. And they do actually take a lot of the money they make and put it into short-term investments, which they kind of just use for the idle cash they have. And then interest-bearing debt. I did assume that the debt is going to increase a little bit, probably just because financing is so cheap. I would assume PayPal to take advantage of very cheap debt financing. 0 preferred shares, we get a value of equity of $225 billion. Now, in terms of shares outstanding, I'd assume they are going to buy back shares. Now, historically, they've been buying back shares. They've been spending between 1 and 3.9 billion in share buybacks in each year the past 3 years. So I assumed the total share count will decrease by 0.75% every year for this model, which may be seen as a little conservative, but I think it is good to build some element of conservatism in your models just because it leaves more room for potential upside. But overall, this leads to a fair value per share of $202. And currently, as of making this video, they're at about $189 a share. So the current price is only about 93% of our projected fair value, which overall would lead to an estimated annual return over this holding period, so about 10 years, of just over 9.5%. So I think overall, these assumptions that I put in are fairly level-headed and fairly reasonable. Now, obviously, there may be some disagreement if you're more optimistic about what the future of PayPal may hold. And that's really what's going to guide your investment decision. Really, the turbo trigger for PayPal is the revenue growth. If you think that they're going to grow at a rate that's faster than what I've projected in here, then your projected return will be even higher. And the reason I'm thinking that 9.5% may potentially be market beating is because we all know that valuations as they stand today are quite stretched for a lot of companies. And there's a lot of, I guess, market forecasters or market analysts out there who are projecting for the next decade stock returns to be flat or very low, or maybe even negative in some cases. So with a company like PayPal, if we're saying about a 9.5% return, if you look at what the S&P 500 has done historically, usually it's done about 10% a year, but that's over long periods of time. There have been times where over a decade it's returned zero, maybe negative, or an amount that's below this. So if you're someone who thinks that the valuations of most companies in the S&P 500 are very stretched at present time, then maybe PayPal offers some form of protection, as given these, what I think are fairly reasonable assumptions, you can reasonably expect a 9.5% return. Okay, so now let's conclude everything we've talked about in this video. So the payments industry as a whole is one where network effects, as we discussed, are very prominent. It's an industry where the rich tend to get richer, and unless there's some major disruption that occurs, it will likely continue to be this way. And some people think that that disruption will be cryptocurrencies or maybe any sort of decentralized finance. But if you look at PayPal, they offer many crypto-related services like trading and digital wallets, so they're on that trend already. And another trend we talked about is the rise of buy now, pay later services. And again, PayPal is on that trend as they have an option for buy now, pay later. So really, PayPal is doing everything you could ask them to do from a competitive standpoint. There's not a whole lot that you can fault them on. And granted, a lot of these other value added services are small relative to their total revenue. They still earn over 90% of their revenue from transaction processing alone. And even though they have these services, it doesn't necessarily mean that they'll be successful, because we know consumer tastes in 2022 and 2021 are extremely fickle. They change very fast. And if people just don't like PayPal's services and there's a better option out there, they will make the switch. But I have to say, overall, I like where they're at. And my conclusion would be that they are slightly undervalued, as the model shows here. They're not a screaming buy by any means, but far from overvalued. And that alone, honestly, may be sufficient, because investing what appears to be a high quality business, even at a fair price, is not necessarily a bad investing strategy. There's many famous investors out there, and their whole investing strategy is simply, number one, identify a high quality business, and number two, don't overpay for it. And you can take Warren Buffett, for example. One of the best investments he ever made was in Geico, the insurance company. And he did very well on Geico, not because he bought it at an extremely discounted price to its intrinsic value, but just because simply it was a great business that grew a lot in the coming years. Now, if I were to compare PayPal to Visa, I would have to say I like PayPal more than Visa, because it seems that PayPal has a lot of different ways they can deploy the cash they generate into new services or different investments, different businesses that they can develop, where Visa is really just this cash generating machine that simply cannot deploy all the cash they generate into new higher growth opportunities. So that's just my personal opinion. It'll be interesting to see how this plays out in the future years. And I'll certainly be keeping tabs on PayPal in the next weeks to see if the selling pressure remains and potentially opens up an even more attractive buying opportunity, as I would be interested in adding this company to my personal portfolio. But anyways, guys, that pretty much does it for me. So thank you so much for listening to this video. I hope you did enjoy it. If you did, then please leave it a like and subscribe if you're new to the channel and you enjoy this type of content. And I'll see you in the next video.